Ladies and gentlemen, federal employees going into retirement, one of the scariest things is not knowing exactly what healthcare needs are going to come up. No one knows exactly how healthy or unhealthy you're going to be in retirement, but having a good plan to protect yourself from huge expenses in retirement, especially as a federal employee, is a huge deal. Healthcare costs are one of the biggest expenses in retirement. So if you're protected for that, you're going to be in a lot better shape going into retirement. So that's what we're going to dive into today. And if you're a federal employee thinking about retirement, you're in the right spot. My name is Dallin Haas. I'm a financial planner. I serve retiring feds and feds in retirement every single day, and I absolutely love it. So let's talk about this topic. How can you protect yourself against huge healthcare costs in retirement? And one of the biggest things, fortunately, that you feds actually have on your side is having incredible insurance through your job. Number one, FEHB. Your federal employee health benefits is incredibly helpful. And being able to keep that into retirement is one of the top priorities. So really briefly, how can we make sure you're eligible to take that into retirement? Well, there's a couple of things. Number one, you have to retire under a type of retirement that makes you eligible. If you just leave the government, not everyone could just take their insurance with them. You have to be eligible. So if you're eligible for a full retirement, which I'll define that really quickly, if you retire at your minimum retiring age with at least 30 years of service, or age 60 with at least 20 years of service, or age 62 with at least 5. You just have to hit one of these and you're good to go. And actually, MRA plus 10. So if you retire with under an MRA plus 10 retirement, I'm not going to go into this super in depth on what this is, how this works. I've got whole videos on what this is. This is technically not a full retirement. There's some reductions to it, but this would qualify you for your FEHB, which is great, okay? Now, there's actually one other requirement as well on top of being eligible for retirement, and that is you have to be covered under FEHB for the 5 years before you retire. The 5 years before you retire. Now, there's a couple exceptions to this. Number one, if you have TRICARE for the 5 years before retirement, that can actually qualify you as long as you jump on FEHB before you retire. So if you're under a TRICARE, you may want to take a look at that if you're interested in keeping your civilian insurance as well. Also, if you have a gap in service, so for example, let's say you worked for 10 years for the government, at one point, then you left the government for, let's say, 5 years, and you came back, worked another 3 years, and then you retired. Right? So technically the 5 years right before your retirement, you weren't covered. You only were covered the 3 years before retirement. But because you had a gap in service, they don't actually count that against you. The only time they would count something against you is if you are an active Fed, and while you're a Fed, you're not covered for the 5 years before retirement. So basically, in this situation, they look at the last 3 years and then the 2 years over here. Okay? They ignore the 5-year gap when you weren't a Fed. Again, it's only a problem if you are a Fed and you opt out of FEHB for the 5 years of Fed employment before you retire. All right. Now, obviously, in 2025, there's a lot of people retiring under a VERA or the DRP. And just know this is a type of retirement that gives you FEHB. So that's a huge thing. But of course, you've got to still hit the 5-year rule for FEHB purposes. So honestly, that's one of the biggest things you can do to set yourself up for success, to have protection against high health costs in retirement, is to be able to keep your FEHB. But we're not out of the woods yet. One of the biggest things you want to check going into retirement is check on your current FEHB plan, because there's so many different plans within the FEHB program. There's Blue Cross plans. I know most of you actually have Blue Cross. I talked to enough of you to know you have Blue Cross Blue Shield, but many of you have Kaiser, Aetna. You want to talk to these plans, these providers, and say, okay, as I go into a time where I may use my plan a lot more, because most of your career, most of you probably have been pretty healthy. You probably haven't used your plan much. You don't really know, how does this cover me when I use it more? You want to ask those questions. For example, what's your max out-of-pocket limit? Which is basically saying, hey, if you had a massive healthcare year, what's the most you would pay until the insurance company pays everything else? That's an important number to know, right? And you can ask your provider and say, hey, your FEHB provider, say, what if I had a terrible year? What's my max out-of-pocket limit? And You want to make sure if you're moving in retirement, does your plan work to where you're moving? You want to start asking these questions to make sure your FEHB will fit for you now, but of course, as you go into retirement. And the good news is, even in retirement, you can adjust your FEHB plan every single open season. You will have open season in retirement. So if you have Blue Cross right now, you want to jump to Aetna or GEHA or Kaiser, you can jump around even in retirement. Now, a couple things to know that FEHB does change a little bit in retirement. Yes, you can keep it into retirement, but the program changes for retirees. Number one is the first question I get all the time is, what about the premiums? Do I have the same premiums when I retire as I had when I was working? And the short answer is yes, you actually do. You have the same premium. So for example, if your premiums were $500 a month while working, in retirement, it'll be $500 a month. Unless, of course, you change plans, then you'll jump to whatever plan the premium has there, okay? So there's one thing to know, though. While the premiums stay the same technically, there's one big change. It actually does increase the cost overall, and that is while working, you get a tax deduction for the premium. In retirement, you do not. So let me give an example. Let's say you're working, your salary is $100,000, and let's say over the course of the year, you pay $5,000 in premiums. Well, you'll be taxed as if you only made $95,000. That's how it works, right? Where you get a tax deduction for the premiums while you're working. In retirement, that goes away. So while the premiums are identical, it will cost you a little bit more in retirement because you just don't get that deduction anymore. So just food for thought. Again, don't have to stress about it, but just know about it. And of course, in retirement, you pay the premiums monthly, not biweekly. Obviously, right now you get paid every 2 weeks. So you pay the premiums every 2 weeks. In retirement, you pay them monthly. So on an annualized basis, you pay the same amount. It's just you pay it on a monthly basis 12 times a year instead of 26 times a year. All right. So those are some of the big changes that happen in retirement. Now, here's a huge one. Here's a huge one. And it is Medicare. All right. Medicare. Medicare can be a really make or break sort of thing where if you handle it well, if you pick the options that make sense for you, it can complement FEHB in an incredible way and set you up for success throughout retirement. But if you don't pick the right options for you, it can set yourself up for either huge premiums down the road or just not the right coverage for you, which neither of those, we don't want either of those, right? So let's talk about it. Now, whenever I talk about health insurance or Medicare, you have to know that there's thousands and thousands of you watching. I really don't know all the medical needs of all of you, okay? But let me give some generalized principles about what kind of decisions tend to make sense for most federal employees here, okay? Let me give you a quick rundown on Medicare, all right? And hang with me. I know this can be boring, right? Some of you hear Medicare and you turn this video off, but please hang with me. This is critical for you as a Fed. Number one, Medicare's got a few different parts, all right? It's got A, B, C, and D are the main parts of Medicare, but the only parts that the vast majority of feds really need to worry about are Part A and Part B. So that's good. We don't have to worry about Part C, Part D. It just, for most feds, just not necessary at all. Part A is free. It doesn't cost anything. You actually paid into the Medicare program your entire career. So because of that, you get Part A, and it's hospital coverage. So basically, there's no reason not to get on Part A in retirement. As far as there's very, very few reasons where you would ever not want Part A. It's free. Why not? However, Part B, that's really the question. So when we're talking about Medicare, we can basically summarize it for most feds is, do I get on Part B or I don't get on Part B? That's what we're talking about here. Now, if you weren't familiar, Part B actually has a premium. This year in 2025, the premium is $185 per person per month. So it's not free. It costs money. So the first question I always get when I say, oh, Part B's got a premium, every Fed has the same question of, okay, why on earth would I pay more money for more coverage when my FEHB has worked great for me throughout my career? Why on earth would I want to change and just pay more money? It's a great question. The short answer is you don't have to most of the time. The only times you'll be required to pay on Part B are, number one, if you have TRICARE. If you're a military retiree and you've got TRICARE, TRICARE requires you to get on Medicare Part B. Or if you work for USPS, many USPS retirees are required to be on Medicare. If you're USPS, look into that, right? But the average federal employee isn't required to be on Part B. That's good news. You've got options, all right? Now, with that being said, most feds do get on Part B. And the reason is for most feds, it is actually helpful. And let me explain why. So, yes, Medicare Part B does cost money, $185 per person. But that's the cost. But what do you get in return? What do you get in return? Because you always have to look at both sides. Yes, it costs you money, but what do you get? This is what you get. If you have Medicare A and B, okay, so Medicare A and B, and FEHB, Medicare becomes primary when you're retired. So Medicare picks up the vast majority of your bill. And then whatever's left, your FEHB comes in and picks up. Okay, and as long as things are covered by Medicare, then basically the vast majority of plans, you have no out-of-pocket costs. Most plans will actually waive things like copays, deductibles, etc., because your FEHB plan, either Blue Cross or Aetna or Kaiser, whoever you have, they love you being on Medicare, right? They're not primary anymore. They love it, and it saves them money. So they're going to save you money by waiving things like copays, deductibles, etc. So you going into retirement, again, retirement, when you're most likely to have the biggest healthcare costs of your life, is probably going to happen when you're retired. You having incredible double coverage with Medicare A, B, and then your FEHB as the backup can be a really powerful combination just to make sure you're not going to get hit with huge bills. All right. Now, one other huge perk of being on Medicare A and B is that many FEHB plans will actually help pay for some of this cost, for Medicare Part B cost. Not all plans do, but for example, this year, Blue Cross Basic is one of Blue Cross's popular plans. They will pay $800 per year per person if you're on Medicare Part B. If you're on Medicare Part B. So, long story short, because most plans, most FEHB plans, not most, I guess some plans, I would rather say, some plans help pay for Medicare Part B, and many plans will waive copays, deductibles, etc., and you got double coverage, so it's exceptional coverage, it can make a ton of sense for most feds. Again, I don't know for you. Obviously, think about your own situation. Look into this yourself, but these are the principles. Now, keep in mind that not all FEHB plans actually play nice with Medicare. Not all of them do. Some don't. For example, Blue Cross Standard. I know many of you are actually on Blue Cross Standard right now. And by the way, that's the more expensive Blue Cross plan. Blue Cross Basic that I just referenced earlier is the cheaper of the two. Okay, Blue Cross Basic is their cheaper plan. Not cheapest, but cheaper plan. And Blue Cross Standard is more expensive. Blue Cross Standard does not pay you any money to be on Medicare. That perk just isn't there. Blue Cross Basic does. Now, I'm not saying you should all switch to Basic. You want to look into that if you want to look into it, but it's something to keep in mind. You want to find an FEHB plan that plays nice with Medicare. All right. Now, the biggest thing I want to address now is, okay, so most people get benefit for being on Medicare. That's what I'm saying. And that is true. Most people we talk to get some benefit for being on Medicare in retirement. However, when does it not make sense? And there are cases when it doesn't make sense. Well, let me explain. If you didn't know, Medicare premiums are based on your income. I mentioned they were $185 per month earlier, per person per month. However, not everyone pays that. Basically, if you're a married couple, I don't have the exact number right in front of me, but it's about $200,000. If your income is below $200,000 as a married couple, great. You will get that low premium of $185. But the moment your income goes over that limit of $200,000-ish, you can look up, if you just look up Medicare Part B premiums, you can find the chart super easily, and they change most years. So you want to look up in the year you're watching this, you want to find it for this year. As your income goes over the limits, the premiums go up. They go up, and they actually max out close to $500-$600 per month per person. All right, depending on what your income is. Your income would have to be quite high to get up to there, but some people do. Some people are up to that point. And if your income is high enough where your Medicare Part B premiums are hundreds and hundreds of dollars extra per month, it may not be worth doing. It may not be worth doing, is what we found overall. If it's super expensive to be in Part B, maybe it's just not worth it. Okay. Again, you have to look in for you. I don't know your situation. It may still be worth it for you. You just have to look into it. All right. So these are the principles that you should be thinking about to make sure you have the coverage you need in your federal retirement. All right. So I hope that's helpful. If you found this helpful, give me a like, subscribe, all the stuff that we like, and we'll see you in the next video.